Welcome back. In this module, we're going to dive into two crucial factors that affect every taxpayer's return: filing status and dependence. As a tax preparer, one of the first things you'll do is determine your client's filing status and whether they have any dependents. These decisions will impact how much in taxes they owe, which deductions and credits they qualify for, and ultimately how much money they can save. Let's break it all down so you'll be ready to guide your clients confidently through this process. Your client's filing status is the foundation of their tax return, and it directly affects their tax bracket, their standard deductions, and whether they qualify for specific credits. There are five main filing statuses: single, married filing jointly, married filing separately, head of household, and qualifying widow. Each one comes with different benefits and requirements. Picking the wrong one can lead to overpaying taxes and missing out on key deductions and credits. As a tax preparer, your job is to help your client select the right status based on their life situation, ensuring they get the best tax advantages. So let's start with head of household, which is a status that offers great benefits if your client qualifies. This status is for those who are unmarried but are supporting a household, whether it's a child or another qualifying relative. Now, the benefits. The benefits of head of household is lower tax rates and a higher standard deduction than filing as single. However, your client must provide more than half of the cost of maintaining the house for their dependent. This status can make a big difference for a single parent or individuals taking care of family members. So make sure to check if they qualify. Next, we have single. This is for clients who are unmarried, divorced, or legally separated by the last day of the tax year. It's the most straightforward status, but it generally comes with higher tax rates compared to other statuses like married filing jointly or head of household. While this status is simple, it's important to know that if your client's situation changes, like getting married, they may be able to switch to a more beneficial filing status, which could save them money in the future. Next up is married filing jointly. This is where both spouses file together on one return. This is usually the most beneficial option for married couples because it often results in lower tax rates and opens the door to a wider range of tax credits. But there are a few things to watch out for here. When couples file jointly, they're both responsible for the tax liability. So if one spouse has tax issues or owes money, the other spouse is on the hook for that too. So it's important to make sure both parties understand this before deciding to file jointly. Now, married filing separately can be a tricky one as well. In this scenario, each spouse files their own tax return, and this generally reduces the credits and deductions they qualify for. In some cases, it's not as beneficial as filing jointly. On the other hand, there are situations where filing separately makes sense. Maybe one spouse has a lot of medical expenses or tax debt. In those cases, it might be better for your client to file separately to keep things clean. So while it's rare, there are scenarios where this option works best. Finally, we have qualifying widow. This is a special status for someone who has lost their spouse, and it's available for 2 years after the year of their spouse's death. However, to qualify, they must have a dependent child living with them. This status is valuable because it allows the surviving spouse to essentially file as married filing jointly for those 2 years, which means lower tax rates and more credits. But after the 2 years, they would switch to single or head of household depending on their situation. All right, so let's talk about dependents because this is where things can get a little bit interesting. A dependent is someone your client financially supports, usually a child or a qualifying relative. Claiming dependents can lower taxable income and unlock credits like child tax credit, which is why so many people get excited about this part. But listen, I know you've heard it. Can I claim my cousin's kids? Or what about my friend's kids? They lived with me for a while. Nope. Sorry, it does not work that way. The IRS is pretty clear on who counts as a dependent, and unless you're financially supporting them and they meet the criteria, you'll need to stick to claiming your own kids or qualifying relatives. So let's leave other people's kids off the returns, okay? The IRS has seen it all, and trust me, they're not going to buy that story. Now, there are two types of dependents. We have qualifying child and qualifying relative. A qualifying child needs to meet four specific tests: age, residency, relationship, and support. For example, a child usually needs to be under 19 or under 24 if they're a full time student and must live with the client for more than half of the year. On the other hand, a qualifying relative doesn't necessarily have to be a child. They could be a parent, a sibling, or other relatives who live with their client or meets the relationship test. However, their income must be below $4,300 and your client needs to be providing more than half of their financial support. These distinctions are important because they determine whether your client qualifies for dependent related deductions and credits. Claiming dependents can significantly lower your client's taxable income. And like I said, unlock valuable credits such as the child tax credit and earned income credit. For each qualifying dependent, your client may be able to save thousands of dollars on their taxes. This is why it's so important to correctly identify and claim all dependents. They directly affect how much tax your client owes or how big their refund will be. Okay, lastly, let's talk about tax brackets, an essential concept for understanding how much your clients will owe in federal income taxes. The United States uses a progressive tax system, which means the more income you earn, the higher the percentage of the income is taxed. But here's something important to remember: only the income that falls within each specific tax bracket is taxed at that rate. For example, let's say a single filer earns $50,000. The first $11,000 of their income will be taxed at 10%. The income from $11,001 to $44,725 will be taxed at 12%. And the remaining amount from $44,726 to $50,000 will be taxed at 22%. This tiered system helps ensure that people pay higher taxes only on their higher earnings. This chart breaks down the 2023 tax bracket for single filers and married couples filing jointly. You can see the rates range from 10% to the lowest earners to 37% for the highest earners. These brackets are crucial because they help you determine how much your clients owe in taxes based on their income. As a tax preparer, understanding how tax brackets work can help you understand why clients are taxed the way that they are. Use the tax bracket chart provided to you in the resource folder as reference just in case you need clarity. In our next module, we'll dive into income types and how to report them properly. See you in the next video.